Hello, and welcome to W3B Talks, an ongoing exploration of the impact of AI, Web3, and blockchain technologies on business and society. I'm your host, Doug Heintzman. I'm the Chief Catalyst at BRI. In this episode, we're diving into the fascinating world of banking systems and the seismic shifts that are reshaping the financial landscape. Our guest today is Emmanuel Daniel, renowned futurist and author of The Great Transition, The Personalization of Finance is Here. Emmanuel spent decades analyzing the forces at play in the financial sector and advises decision makers around the world on financial services and geopolitics. He divides his time between Singapore, Beijing, and New York, and when he's not traveling around the world, building material for his next book. And we're very, very fortunate to have him as a guest here today to share his insights on what the future holds for banks, fintech, and the broader economy. Welcome to the podcast, Emmanuel. How are you today?
I'm very good, Doug, and very excited to be on your podcast because I see some of the good work that you do on so many fronts, and I'm raring to go to add the financial services component to your thought processes and to the things that your audience are interested in.
Well, this is a really great topic, and it's one that I have quite a bit of personal passion. I work with banks and banking associations around the world, as you do, and I really have a sense that there's a lot of change going on. There's stress in the business, but it's an interesting kind of stress. I mean, yes, it's a stress that there are threats to our business model, but just under the surface of that, there is this idea that there are some really interesting new possibilities, some new changes, and coming because there's a lot of technology that's intersecting, and it's going to allow for some really interesting new configurations in financial services. So just to put things in perspective a little bit, I was doing a little bit of background research, and Accenture did a global survey, and they found that 30% of the respondents rate their bank's customer service as excellent, only 30%. 23% rate their banks highly for their range of products and services, for the competency of its tailored financial services, only 23%, and 59% recently acquired a financial service or product from a provider other than their main bank. Those statistics, if I'm a banker, I'm sitting back going, wow, there's work to be done, and there's a lot of alternatives in the market. And so I would be feeling a little bit of stress. So that's kind of one dynamic. There's changing consumer expectations and consumer behaviors. And the other reality, the FDIC pointed out that in 1982 in the US, there was 14,551 banks. In 2002, there was 7,887 banks. In 2022, there was 4,136 banks. And they forecast in 2042, there will be 1,940 banks. And in 2082, only 438 banks. So you can see where these trend lines are going, that there's just huge amounts of shifts going on in the marketplace. So how do you see the current landscape and where you think things are going from here?
I've been following the banking industry since 1996 when I started the Asian Banker, and that gave me a frontline perspective of what traditional banks were doing. For the longest period of time, all I was recording was incremental changes in the productivity of banks by absorbing technology. We've now arrived at a point where there is no longer an incremental development of the industry. We've come to a point of inflection. And the point of inflection is, technically, the technology enables us not to even need banks in the first place. The top technology has made this whole business of intermediate irrelevant, at least conceptually. And so banks are, falling over themselves to regenerate and redefine what the relevance of an intermediation business is in everyday lives of people.
Well, right? Emmanuel, let me just. I apologize, but let me just interrupt you there, because as you were saying that, it occurred to me that there is a very fundamental question that shapes this entire discussion. And that is, what's the point of banks? I mean, what's their purpose? And why do they exist in their current configuration? Because if we understand that, then I think we'll have a lot better ability to anticipate where things are going from here. So why don't we just take a step back and ask that question?
And that's exactly where the inflection point is at the moment. This whole business of intermediation has come under the microscope, and the everyday person is saying that, look, if cryptocurrencies, for example, enables you and I to make peer-to-peer transactions between us, the institutions that stand around us and try to be relevant to that transaction, they've got to figure out why they are important. And there's only one reason why the business of mediation are still important in finance, and that's because they're licensed institutions. And they're licensed because trust is really the remaining point of relevance that financial institutions play or provide in the new ecosystems that are evolving. With that at the back of our minds, when we look at the number of institutions, there are many different metrics to look at how the industry is scrambling to continue being relevant, right? So when we take the automobile industry, for example, from the time that Henry Ford perfected the supply chain and the manufacturing of cars, by 1920, there were like 2,000 auto manufacturers in the US, and everybody was in the game. Today, we have like 3, 4, and even that is being disrupted at the moment. So I think that the financial services industry will go through a similar process of having to redefine its relevance. And right now, there are two areas where finance is being redefined. One is in the area of digital assets, and the other is in the area of payments. And on that front, all of the work that you do, Doug, on blockchain, on the whole intermediation game in other industries come to bear on the financial services industry. The Bank for International Settlements, when it looked at what crypto and blockchain was doing to payments and try and embrace this technology for banking, and they came up with this thing called the central bank digital currency, right? And that was the banking industry fending off dismantling of the intermediation game by saying that the central banks will issue the currencies directly to the end user and so on. And they've gone through a process of learning what's possible or what's not possible in the intermediation game. So the first thing that happened was that the central banks discovered that if they didn't need intermediators themselves, which means that a central bank, a retail CBDC directly to the end user, then that calls into question the entire banking industry, the relevance of banks in themselves, and that the central bank didn't need to use the banking system to distribute money and payments, into the economy. And then it took a step back and tried to redefine it again and again and again. And where we are today is, it seems to me that the Bank for International Settlements has taken a step back from the idea of a retail CBDC and is now encouraging banks to tokenize their deposit business. And what that means really is that banks have already digitized their deposit business. And we saw the effect of digitization when Silicon Valley Bank, for example, you have a bank run within seconds of by Peter Thiel. Within one day, $10 billion gets lost and gets out of the system. And then by the end of the week, the bank becomes insolvent. But they're taking that to another level, which is to encourage banks to tokenize their deposits. And in several countries around the world, some in Africa, some in Asia, the banks are already putting in place new technologies to enable their consumers to treat the money in the bank account as a token. In other words, it's a digital version of actual cash, that when you take the token out, you're able to go out and do things with it.
There's a whole bunch of really important ideas that you had in that answer. Let me just tease it apart a little bit. Right at the beginning of your answer, you talked about trust. And it reminded me, I was doing a brief for a big bank in Africa, and it was a big strategy session. The top management team had spent 2 days discussing where they were with the bank and where they wanted to take it. I presented halfway through the second day, and I asked them about the progress they're making. And they said, well, we spent a lot of the time talking about our core value proposition. And I said, well, what did you come up with? And he said, well, basically, the bank is all about trust. All we do is to build trust, to build upon the regulatory framework that provides a foundation for that trust, and then build a brand around businesses and consumers trusting us with their assets, with the value that they own. And I said, okay, that sounds like it makes total sense. And of course, as you were pointing out, is very much the foundation of the banking industry. And then I had this very big dramatic pause. And I said, well, what happens if that's not true anymore? And they kind of looked at me and I said, well, right now, you're a trusted third party. And you're trusted because there's value in your brand and your reputation, and because there is a regulatory framework in which you operate. I said, but what happens if trust is a fundamental attribute of a digital network? What happens when I can interact and transact with someone without the fear of renege, with assurance that the counterparty assets are in place, that the transactions can be accomplished incredibly quickly with huge fidelity and reliability? What happens in that world? And the looks on their faces as they looked around the room, trying to contemplate how profound a question that was indelible. So that's kind of the first part of the story that says that there are these technologies, specifically blockchain, the common state engine, and artificial intelligence, that are really providing a completely new level of infrastructure. And the question for banks is, what role do they play in a society, in a business economy that is built on that kind of infrastructure? So that was the first big question. And then the second big question is the second topic you were getting to, is the question of assets. A lot of people don't really realize that most of the money that we interact with is invented by banks. There's a bunch of different kinds of currencies, central bank currencies, but most of the currency that we interact with is commercial currency. It's invented by banks when we need it. When I go to get a mortgage from my bank, they don't go to some big vault and count out dollar bills or whatever currency you're using that they've got from some central bank. They invent it digitally, and it moves around digitally until it stops existing. And then they invent some more. And so they play this really critical role, aside from being a repository for our assets, but being a mechanism that allows those assets to come into existence and to circulate. And this whole discussion about digital currencies is fascinating because they make so much sense because of their efficiency, because of how they can facilitate cross-border transactions and international trade finance, and really make supply chains a lot more efficient. And in some economies, right, in China, one of the biggest problems was that people were having to put deposits on their first month of rent, and they'd have to show up with a backpack full of bills. And this just was untenable. So having a digital version of that can run around in a mobile wallet with proper encryption on it just makes a whole bunch of sense. But of course, if you're dealing with commercial central bank digital currency that is designed for retail, and if it's interest bearing, then you've got this question of why would people maintain checking accounts and do retail banking at banks? Why wouldn't they just do it with the central bank? Because there's much less risk. And then that topic takes us to the third thing you were saying, which is about the danger of velocity. In a digital world, the risk that there is contagion, that because of a rumor, because of the fear of a run on a bank, right? If there was a fear of the run on the bank in olden days, you'd have to run down to the bank and get in line, and they would dole you out some portion of your savings, hoping that they had enough reserves. But in this day, you press a button and suddenly tens of thousands of people on their mobile phones are taking money out. And so the risk of contagion is really huge. So we've got these three topics, right? We've got trust, we've got the digital currency, backplane payments issue, and then you've got the risk coefficient, which is the fact that in this digital world we're living in, we've got this risk of accelerated contagion. So with that kind of as a framework, let's break them down a little bit. Digital currencies, let's deal with that one because the digitizations of assets is a huge, huge issue. So let's just focus in on that topic and then we'll get to the other ones.
Yeah, but let's start with the trust element. So the good thing about banks, especially as they're making that transition into the digital and tokenized world, is that, and the title of my book, by the way, is The Great Transition. In other words, the whole industry is in transition. And as it makes this transition, what's interesting that the banks have achieved is the institution of trust in that transition. And the reason is to give credit where it's due. The regulators have put the banking system on a higher level of accountability for ensuring certainty of transactions, safety, security, and the ability to withstand new forms of risks and operational risks that are coming on stream, especially cybersecurity, for example. So there are a whole list of new entrants to the industry, new payment platforms, fintech startups, and so on. They're all as good as long as on the day they get into trouble. They either go under or there's a glitch in the bank, in their payment system, something like that. And that very rarely happens in traditional banking just because of the layers of control, compliance that is put into the structure. And that's the gold standard to which any new player will have to be. So that's the point that I want to make on.
I think you're on a really, really important point. And in that same briefing I did for this bank in Africa, I showed them a picture that was my imagination of what I think is going to happen to the industry, because you're quite right. There's a huge proliferation of neobanking services and of distributed financial services and all kinds of non-bank ways of doing banking and consuming financial services. And by and large, I think that's a great thing. There's been a huge amount of innovation that we didn't see before. Much more of the world's underbanked and unbanked now have access to banking services than was traditionally possible. And part of that is because banks have mandated open banking, right? They've put laws in place in a lot of jurisdictions that say that banks can't hoard their data, that they have to provide application programming interface access to those records. And that's allowed all kinds of neo-financial services companies to come into existence and fill niches in the economy and provide all kinds of innovative services. But what I think is going to happen is that open banking was the first step, and that DeFi and blockchain and all those technologies are kind of the second step. And I think what happens is what we know as banking starts to consolidate down into core banking services, the stuff you were talking, stuff that's heavily, heavily regulated. But there's a compression of the things that banks really do and do well and focus on to provide that core of stability, highly regulated core banking services, and they're in the middle. And then there's going to be this outer ring around it that has all these neo-banking and neo-financial services that are merging and integrating with insurance offerings, with utility offerings, with all kinds of other, we're going to help you manage your entire financial life, integrating different services offerings. And that's going to be great for the consumer, great for small businesses. And that the banks in the middle that are providing those core banking services, they're going to differentiate themselves on the cost of their services, on the speed and quality of their services, and on how composable they are, right? How much effort they've put that their interfaces into those core banking services are consumable by that outer ring of companies that are going to compose those core banking services with all these added value services. And that's a complete reorganization of the banking sector. So that was the vision I put in place. How do you see, what's the map in your head? What does it look like?
There are two maps in my head. One is on the payments front. And as I described just now, the Bank for International Settlements is taking central banks around the world on a journey to tokenize the deposit base. And that's after having experimented with retail CBDC, which works in parts, but not wholly. And it's even being rejected in the US. I think Congress is putting legislation through to make sure that the US will never consider retail CBDC because it's an invasion of privacy and all of that, despite the fact that Janet Yellen loves retail CBDC. And the technology is making tokenized deposits more interesting for the banking industry. And several banks around the world are experimenting on that front. In my estimate, there's a very great likelihood that we'll move into a tokenized deposit business. But when we go into a tokenized deposit, in short form, what that actually means is a bank-issued stablecoin, and banks competing with each other on issuing their own stablecoins. And the competition moves from the interest rates that they can provide on their interest-bearing accounts to functionalities on their tokens. what they enable their end user or their customers or their depositors to do on the back of the tokens that they have. So tokens will have to be, from the get-go, interoperable. It should be programmable, and it should be applicable, and you should be able to develop APIs on it and so on and all of that. So the nature of competition in bank has a very strong roadmap to being transformed from interest-bearing accounts to functionality. So that's one journey that I see the industry make. There's already experiments taking place around the world today.
Yeah,
Sorry, go on.
On that point, so there's a few different variations. There's the retail central bank digital currency, which a number of geographies are pursuing. Certainly China is way out in front. They've been working on it since 2014 or something like that. India's made quite a bit of progress. There's a lot of these projects around the world. There's like 89 central bank retail digital currencies that are currently, some of them are in production and most of them are experimental. There's a smaller group, something like 27 countries, that are working on wholesale central bank digital currencies that is slightly more aligned with the banking system as we know it. And then you've got the effort largely in the US around tokenized deposits, and JP Morgan is the leader out in front of that push. So you've got these different models, and I think they will compete. I think I suspect that there are going to be different answers for different geographies. There's some geographies that a retail CBDC makes a lot of sense, and there's going to be others that's much less so, that have many more concerns around privacy and the idea that the government's owning an account-based system, and that a banking, either an individual bank-driven stablecoin or a banking industry stablecoin, or maybe even a commercial. I mean, you've got companies like PayPal and Circle and others that are providing commercial stablecoins. So that's actually an interesting question. What's the difference between a banking stablecoin and one of the stablecoins that we know, Tether and Circle's offerings?
So why do we need stablecoins? This question brings us right back to the point of trust. The stable coins that we now are familiar with, Tether, the USD stable coins and the currency-based stable coins that we know today, the single biggest problem they face is that of trust. That the underlying asset created to hold the value of the stable coins cannot be trusted. They're not being audited sufficiently enough. And so it goes back to the banking industry to be able to provide that layer of trust. And that, I would say, is the most important difference between a bank-issued stablecoin and one that is issued by any number of players out there.
But you could argue that, look what happened to Silicon Valley Bank. In essence, they were backing their holdings and the record of people's savings with long-term bonds and the like that they were using as a backing feature in order to generate enough income to pay the interest rates that they were offering. And the whole thing collapsed. And they were a bank.
Yeah, and that is exactly why the FDIC came in to backstop that. Although it didn't owe a duty of care to the end user, it couldn't allow a knock-on effect to affect
and the FDIC limit was $250,000, but they had to kind of break all of those rules. And ultimately, that's a banking industry insurance program. It's not really the government backstopping it, it's the collective banking industry.
The trust couldn't be broken, and the trust needed to be upheld at almost whatever cost. If there comes a day where the regulator or the central bank refuses to honor that trust, then the banking industry and banks specifically fall into the same category as the new players that come on stream.
If you segment it, so there's cost to trust, right? Trust is expensive because there's regulators, because there's systems, because there's tons of cybersecurity, because it's a costly thing to do. And in theory, some of the blockchain technology changes the economics of trust. So do you ascribe, or what do you think of my vision that banking really compresses and consolidates down to those core banking services that involve high degrees of trust and regulation, and that there's this broader landscape that is just going to flourish with all kinds of inventive and innovative services? Do you buy into that vision?
That's where we are right now, which is that there's a whole range of innovation taking place on the periphery. But when you calculate what percentage of the total it is, not even 5%, 95% of financial intermediation is still within the banking industry. So that equation hasn't been broken yet. It's only when we break that equation that we then enter a different realm where institutions have to reinvent themselves. And we are getting into that game by enabling banks to issue their own versions of tokenized deposits, which then at least changes the rules of engagement, which is, as I said, is no longer interest bearing, but functionality that determines the winners and losers within the banking system. And I can't wait for that day to become a reality in a number of jurisdictions. The thing about retail CBDCs and even the wholesale CBDCs is that it's the tail that wags the dog. It's the innovations taking place in crypto that are setting the pace and the tempo and standards for the traditional banking industry to catch up with. So if you think about traditional banking industry, it is on the back of core banking systems that are set on mainframes, that have applications that have millions of lines of coding in order to be even competitive on a normal product basis. A bank takes months to code a new product or innovation with the existing system. Whereas crypto is introducing new products, new applications, it's open source. Any number of players can do their own little variations of a staking or a gaming application on a crypto. And that's what banks now have to aspire to. And crypto is traded 24/7. A core banking system shuts down at the end of the day for batch processing. So the standards are being set for the banking industry to start emulating best practices that already exist in the crypto world today.
And I think that's healthy, right? That banks just haven't had that competitive threat and the motivation to innovate. I think writ large, this is pretty healthy, which kind of takes us to the third topic that you had introduced, which is the question of the risk and of velocity and accelerated contagion. How do we incorporate the realities that, with all of the benefits that a digital world brings us, there are these downsides that provide a risk of instability? How big is the problem, and how should we look at it? How do we think about it? How do we try to deal with it?
Now, in my book, I borrowed an idea from a Rand Corporation futurist himself in the 1990s, who had suggested that society actually moves from tribal to institutional, from institutional to markets, and then markets to networks. And I can see that we are in a transition from markets to networks. Banking, as we know it today, is a market infrastructure. Willing buyer, willing seller, the transaction takes place, end of transaction, there is a beneficiary and an issuer, a winner and a loser.
And a clearinghouse in the middle.
That's right. And in the network world, there is not necessarily a buyer, a seller, or a winner and a loser. The more networked we are, the more valuable the assets that we carry. And the most interesting asset of all is information itself, data itself. Data becomes more valuable, or information becomes more valuable, the more it's actually shared out into the network, and whoever's sharing it becomes the beneficiary of the wealth created from information. And like that, any information-based asset going forward will have that effect. So the idea in a network world is not to manage a living room door and have control over who gets in and out. It's to keep that door wide open, and the security comes from the fact that all of the players actually know each other, validate each other, and keep each other honest. This rule applies even in cybersecurity, which is, in cybersecurity, you cannot even create the smallest amount of friction on your applications for your users to come in and out of your system. At the same time, you need to keep the bad actors out. And so how do you do that? And that's the network effect that gives you that security. And the whole industry is in transition, from the model that we are familiar with, where a bank, opens its branch door at 9 o'clock in the morning and safely closes it at 3 o'clock in the afternoon and then starts counting the cash, to one that it's 24/7 and it's validated instantly all the time. So that whole business model is in transition.
It's fascinating to think about where we've come and where we're going, I like what you were talking about. It makes sense to me, this idea of networking, that when things are networked and there's an underlying efficiency of the transmission and awareness of information, there's a lot of transparency. At large scale, that improves liquidity because the entire system can adjust much, much more quickly. And I also think that it allows, especially if it's designed to be composable, that allows for much more hedging positions, much more insurance-oriented offerings, many more instruments that can detect the fluctuations in the market and the dangers of some sort of contagion that velocity could accelerate. That very fact of velocity also means that the market can react to those things very quickly, and that those various different hedging positions can come in and adjust for that instability very efficiently. So I do think there's a bit of a double-edged sword. The last thing that you said that I thought was interesting, because there is this whole other risk element in the digital world, and that is that it used to be that bank robbers had to get a crew and drills and dynamite and break through the walls of vaults and stuff, with the stuff that's in movies. And these days they can be sitting in some rogue nation or in a basement somewhere and steal hundreds of millions.
And because of the network effect, that hundreds of millions can still be traced. Even if it is unmarked tokens, so to speak, it's easy to zero into where the perpetrators come from.
That's true. The other side of that, of course, is it's an arms race, right? Because the other side of that, of course, is that when someone does discover an exploit, a door in, that across the dark web, that information can be spread to other scammers, other hackers, and new innovation can be applied to using the exploit in new kinds of ways. And so that can also be accelerated. This allows me to introduce the other big topic that we really haven't got to, which is AI. And I think that artificial intelligence, looking for those patterns and monitoring that network behavior to detect those kinds of patterns, is going to be a big part of the story, already is a big part of the story. But of course, the other side of that equation is true as well, that the bad guys are going to be using AI to try to detect vulnerabilities and weaknesses. So let's just reset. We've talked about trust, which is a lot about the blockchain and the network and digital assets. I wanted to go a little bit into the idea of fractionalization of assets and the doors those open, but maybe we'll just put a pin in that and hold that off. Let's talk a little bit about the whole AI question. I've also been talking to a lot of banking conferences and investor conferences, and AI kind of breaks down into a bunch of different topics. There is the cybersecurity aspect of AI, which is a very deep hole to go into. There is the customer service attributes of artificial intelligence. Intelligent bots now take up an awful lot of the heavy lifting of interacting with clients and providing timely information and giving people their account balances and advising them on when to renew their mortgage or whatever that is. And some of the numbers are just amazing, the hundreds and hundreds of millions of service engagements that these intelligent bots have done. And then you've got this whole space that AI is stepping in to provide advisory services. AI's ability to understand the dynamics of immensely complex systems holistically. Humans are very good at reductive logic, but we're not very good at holistic systems. And AI is almost the exact opposite. At least until now, we haven't had truly reductive reasoning engines, although that might be changing in the near future. But what AI engines currently are really good at is analyzing holistic systems at very large scale and understanding the sophistication of these systems in ways that humans cannot possibly process, because we're not designed that way. That the idea that I would give my life savings to a broker or a wealth advisor to manage and figure out how to optimize return on, and hopefully be sensitive to my own personal investing priorities, because I don't want money going into carbon fossil fuel industries or any other industry that I have a personal philosophical belief that I don't want to support with providing investment capital to. Or my kids are going to be going to university, so I need some conservatism or getting close to retirement. There's all kinds of personal things that are a lens into how my assets are being used. I have this thought, we're not too far off from a world where I have a personal assistant that lives with me, that understands the way that I think and what my priorities are, and has a holistic system view of what's going on in international markets and momentum flows and emerging technologies that have a lot of promise, that we're going to be in a world where that becomes the dominant model, where we have these agents.
So you just answered your own question, which is that the problem that the banking industry has in dealing with frontier technologies is that it keeps thinking a supply side technology. In other words, the power of the equation is on the side of the institution, not the side of the customer. The second half of the title of my book is The Personalization of Finance. It's here. What happens when the AI sits on the customer side of the relationship? That changes the ballgame. Now, the stuff that you talked about, which like chatbots going AI, personal financial managers, and that kind of thing, is that the bank keeps imagining that the information that is within the institution is more valuable than the information that sits outside the institution. Right? And the industry really has to make a huge transition to understand that AI is intended to tame the information that sits outside the industry, outside the institution, and is in the hands of the user, who then can decide which institution he wants to use, and he can even decide what his portfolio looks like and all of that. And when that happens, the institution's relationship with the end user changes dramatically. The agents no longer sit on the chatbot side. They actually sit on the user side. And the user can understand the supply side because the agent is able to garner a lot of information from all kinds of sources and so on. And something I say to the banks is this, that if your product doesn't change, nothing changed. If you're still trying to sell traditional structured deposits or mortgages using AI and using all of the data that you have access to today, then you have achieved nothing. You know, the whole idea of what it is that customers want to buy from us in a networked world, in a world where there is symmetry of information between supplier and end user, that the products themselves have to change in the future. It's when I see the products change that's when I call it a real transformation that is taking place in the industry. And banks have been very slow in getting there.
That's a really interesting observation. When you think about it, the information that a financial institution has in the grand scheme of things, in the entire financial network, is an incredibly small piece of the puzzle that is so small that it couldn't possibly determine the macro patterns or even the industry-specific patterns.
Imagine what actually sits on a GL. A general ledger is historical, is static, is passive, and it tells you nothing about what the client is doing right now, and it's not even real time. So,
it knows nothing about their lives, right? It doesn't know that their daughter just got sick and is in the hospital and they're going to have to take 4 months off of work. It doesn't know a ton of stuff about people's actual day-to-day priorities and how those priorities are going to change their investment profile in either big or small ways.
The more information we have, the static part of the information, it's going to become smaller and smaller as a percentage of the total. And over time, we're going to see regulators paying less and less attention to that and letting it go. We are at the point where regulators bear a lot of weight on the banks to protect that small piece of information. So I think that as we go into quantum computing, for example, we will start seeing that the universe of information that we have access to and are able to harness is much, much bigger and much, much more real-time than what we're dealing with today in financial services.
You opened that door. So quantum computing, let's just take a quick tangent because
we are on the verge. We are weeks away from quantum computing.
So that's terrifying.
We need to start.
So that's absolutely terrifying because I think in the banking space, there's really two big issues around quantum. The first and probably most pressing one is the security problem. fact that we're just going to break RSA with Shor's algorithm, and it's going to be a problem that all of the records that we have, both the current ones and the historical ones, with a relatively small amount of quantum computing power, we're going to be able to break encryption and open up people's accounts. So that's problematic for a few reasons, one of which is that if you're right, if it's going to happen imminently, then we're in serious trouble. But even if it's 6 or 8 years out, or maybe we're even more conservatively 10 years out, we still have a harvest and decrypt problem. We've got the problem that we have records that are sensitive and will be sensitive historically, that people can just grab those records, put them in a closet, wait some number of years until a commercial quantum computer is available, and then open up all those records. So even well before quantum's a reality, we have to get really serious about figuring out how to re-encrypt the things that are going to be sensitive in the future today.
One of the first questions I asked when I was wrapping my mind around quantum computing is, will someone be able to, break on Bitcoin? And the answer that I got is that the more networked it is, the safer it becomes.
I think there's actually a really big problem there. Yes, that's true to an extent. And it is also true that you can already get quantum-proof wallets that are designed with some of the new lattice math encryption algorithms that have been recently certified. And that's great. What I think is so fascinating is the Satoshi wallets that have just such vast amounts, billions and billions. I don't know how many it is, but it's just a huge amount, $45 billion worth. A very large portion of the marketplace are locked up in some wallets that have never been used, never been opened, never been touched. They're sitting there. And if you can go and hack those keys, which is a hugely difficult thing to do with conventional computing. It would take you near the age of the universe to try to hack those things. But with a quantum computer, you could. It's not inconceivable that some consortium of people would crowdfund $20 million to launch a quantum attack with the potential of getting access to $45 billion worth of Bitcoin. And the very threat of that, the very possibility of that, is potentially very destabilizing. I mean, if you were investing in Bitcoin and you're holding a lot of reserves in Bitcoin, and there was this threat that someone could suddenly grab and flood the market with that amount of Bitcoin, that's a pretty terrifying position as an investor. So I do actually think there's potentially a problem just in that one attack.
But at the same time, a big actor like that can't go away unnoticed.
They've got the keys. If you've got the key in the crypto world, it's not your identity. It's that you own the keys. And if someone has the keys to open those wallets up, I mean, who's to say they're not Satoshi, right? They're not stealing it from anyone. They've got the keys.
As I wrote this book and I came to the end part, I said to myself that if finance is going to be highly personalized or highly open and all of that, society itself will need new rules of engaging and holding together. So we're no longer talking finance anymore. We're actually talking how the society that we live in, engenders trust, stability, social stability, and mutual interaction with each other. A whole range of things have to be transformed at the societal level. So when we look at a finance problem, we should not think that the solution is also a finance solution. The solution may be all of society's solution, that we need to broaden out how people live, how people trust each other, and how people interact. That's the profound change that is taking place in finance that is going to change how society itself holds together.
Well, the other potential disruption of quantum computing, in my mind, is its ability to simulate complex systems. It's going to be used to do protein folding and discovery of drugs, and traffic systems can be modeled in quantum computers to optimize traffic flows in ways we've never seen before. Relatively complex system in a large city. But the ability for quantum to model and simulate and do analysis on very complex global financial markets, and some country just decides to declare an irresponsible war, and various different countries are going to figure out how to put sanctions on them to convince them not to continue doing silly things, hypothetically. Being able to model all of that stuff out and do very, very high quality, detailed simulations is going to be a pretty powerful tool. Do you see private companies becoming these financial market analyst experts that are using these powerful quantum tools to do that? How do you see that technology intersecting with impacting that part of the market?
Where we are today is that the individual investor stands alongside the algorithmic traders, the robots that do trades automatically, the meme stocks, large numbers of individuals grouping together to try and move markets against institutional investors. So that there's a whole range of different types of players in the marketplace as we know it today. And I think that quantum computing is going to just put all of us on the same platform, on the same footing. In other words, all of us have as much access and symmetry of information as each other. And so that's a big game changer in that each of us can make decisions that a institutional investor that used to be able to make, or an algorithmic trader would be able to influence the market and all of that. So when that happens, markets will change as a course in the course of its own evolution. In fact, markets are already changing today. Markets as we know it are supported by venture capital, by private equity, by funds. And that knock-on effect on valuations are not linear anymore. The US may look a little linear today, but even there, markets are gravitating towards a few highly productive stocks at the expense of everything else. And in other parts of the world, in Singapore, for example, there is no longer a price discovery mechanism in this market. And nobody seems to know why the market has lost its price discovery mechanism. In other words, you can't put an IPO into the market because it won't find its natural valuation. And almost all IPOs fail today in a number of jurisdictions. The whole idea of markets out there to be revolutionized as we put on the network effect and we put on information. And we don't really know where this is taking us. But in a more networked world, in all likelihood, as you suggested, there will be more liquidity in the marketplace, and that winners and losers will be transient. There's no holding value that you might be a winner for 1 second and then the market moves on to the next meme stock or something like that. So the nature of markets also change. Even the nature of something as simple as the mortgage business. The mortgage is probably the most important single asset creating mechanism that we have in society today. You go in there, you buy a house, you are indebted for like 8 to 30 years. And at the end of the process, you have something that carries an asset that has defied inflation and creates wealth for you. Imagine what markets will look like, or the mortgage industry will look like, if the mortgage or the property registry is highly automated, that you can actually transact or flip property by the second rather than by the day or by the months in other countries. Or if a bank loan can be transacted within the day or on an app rather than going out to the bank to sign in a lot of forms. The whole idea of mortgages as a business will change. Mortgage will no longer be a wealth-creating asset. It will become a transient asset, a lifestyle-defined asset rather than a wealth-creating asset. I think that on many different fronts, a lot of what we call financial products today will start to look very different. And that definitely will happen on the markets front. And I'm actually asking myself a lot of questions, putting down notes on why markets have become so transient lately, especially on the price discovery front.
You made a really interesting observation there. You talked about mortgages, and there have been countries around the world, Sweden's a really good example, of jurisdictions that have digitized things like property registries. And once they're digitized and once they're actually put onto a common ledger, the ability to run transactions against them with confidence accelerates dramatically, and you're able to compress 30 days of legal and financial transactions down into a matter of hours. And that efficiency has some dramatic effects The other part of that whole equation is that once those assets are digitalized and registered on ledgers that people have collective confidence in, you can start fractionalizing them. And that opens up all kinds of interesting investment opportunities for people to participate in things like the real estate marketplace that have traditionally had very, very high barriers to entry. But if you can very easily fractionalize an asset and those assets can be collateralized, then that really changes things. And if we can start digitalizing assets, things, not only houses, but cars and boats and a herd of goats or sheep, then we start to be able to have collateral and start to have access to capital in ways that asset owners didn't have before. And if we have markets that can fractionalize and bundle those various different assets, we can create all kinds of greater efficiencies and bring capital to where it's needed much more efficiently.
I actually participate in a fractionalized property business in Europe, and the value that the intermediary or the organizer of this fractionalized platform does is that they do the back office for you as the owner. They go out there and do all the old-fashioned stuff.
Then they do the clean property management, that stuff.
Yeah, and when the old-fashioned stuff is done in an instant, the market itself becomes ephemeral, meaning that you think that you are investing in a hard asset, but actually you're investing in something that's incredibly transient, and you can hive off and sell and fractionalize even further as you like. Something else I say in my book is this, that anything that can be digitized can be financialized. I say in my book that the world will go through a process of trying to figure out which of these new financialized assets that we are able to create are sustainable, in that not everything that can be financialized will be successful. But we will probably spend the next 100 years digitizing so many things and then financializing them to figure out whether you can create a market around that, and then we'll fall out of it. Like even in the fruits market today, right? You can financialize kiwi, because kiwi, the fruit lasts longer. It lasts like 6 months or something like that. So you can actually create a futures market for kiwi, but you can't create a futures market for something else like oranges, for example, because they rot very quickly. So in that same way, as we financialize a lot of different new assets, we'll discover what's sustainable and what's not. And that's like the next 100 years.
If you throw IoT into the equation, where you as an investor, or
you got it. Yeah.
If you as an investor or as an insurer can have confidence of where stuff is, whether it's in transit because it's in a container going across the ocean, or it's in a warehouse somewhere, that if you have confidence that those things exist and what their condition is and where they are and how close they are to a market, then that allows you to start insuring them or collateralizing them in ways that were never possible before. So we can turn a lot of assets into capital and put that capital to work in ways we never could before. This whole discussion, which takes me to one of the last topics I really like to touch on before we sign off today, is really about inclusion and emerging markets. I mentioned this idea that you might have an asset that is a herd of goats or sheep or whatever, that there's inventory of alpaca fiber, whatever it happens to be. There's a lot of people in the world, a huge number of people in the world, that do not have access to the traditional financial services and banking system. And they might do microloans that are coordinated out of their local village by some effectively accountant for the village that figures out how to collect and collectivize the resources to deploy them efficiently in the community. A lot of people just view their phone or their phone company as their bank and use it as their payment rail. So we found a lot of innovation that started to allow a lot more people to be included in the financial system. Remittances are becoming a lot more efficient because there's been a huge financial tax on remittance payments. And that's coming down and being commoditized a lot more because of blockchain technology. So it seems to me that we've made a lot of progress over the last 10 years in terms of inclusiveness and helping the and underbanked people being included in the system and having access to financial services and capital, as well as the investors are now able to invest in microloan payments that ultimately their capital is being deployed by local farmers that are working small plots. And we now have the tools to be able to do that. How do you see the world evolving? Most of people like me and you, I suspect, have had a pretty limited view of what banking and financial services look like just because we haven't spent a lot of time working fields and managing day-to-day finances in places in the world that don't have access to these kinds of services. How do you see the world changing?
The World Bank puts out an annual report detailing a little bit about financial inclusion, and its definition of financial inclusion is the percentage of the world that doesn't have access to banking. And every time I read the report, I ask myself, why is access to banking the only way of understanding financial inclusion? And when I go around the world, I point out that in Bangladesh, for example, that used to be a basket case. Grameen Bank perfected the idea of 6 women borrowing money from this NGO, a non-government organization, and creating their own wealth and keeping each other honest and so on. And the culture of tontins is highly developed in many different, developing countries. And then when you go to Kenya, the whole idea of a payment system that originated from the telco industry holds the whole financial infrastructure together, and so on and on and on. We should not imagine that financial inclusion, wealth creation, and remittances and payments should be defined by the banking system that we are familiar with. We should have faith in humanity. And humanity has many different forms of organization and holding together that are not captured by the informal banking system as we know it to be. And digitizing finance also means digitizing many of these informal systems, and that's what we need to do. And finance is a means to an end, not an end in itself. In other words, the repository and the beneficiary of a new financial infrastructure shouldn't be the formal banking system. It should be society as a whole. So if we have that in the back of our mind, I think that we will be much more open to what kind of different forms of organizations that can exist that can be financial intermediaries. One of the examples I give in my book is the dancing community around the world, whether it's ballroom dancing or salsa or tango. All of these have rules where dancers around the world know exactly what steps they need to do to dance with each other, whether they are dancing in Argentina or Los Angeles or Singapore or Tokyo. And there is no committee that brings it together or that holds it together or defines the rules or calls something a foul. Humanity has a way of understanding rules, creating them, and then transforming them over time. New dance steps get formed all the time. So we should aspire towards humanity being able to govern itself, and that's where the network effect comes in, and create wealth and community and stability that we're all aspiring to. And that's what finance should be aspiring to.
So that's a really interesting worldview, and it really leads into my last, and it's maybe in some ways my most fundamental question. The vision you're painting here is a big change. The way that the banking system worked historically is being changed quite radically because of technology, because of all kinds of social and geopolitical factors. And it seems to me that we're going to need some new thinking, some new strategic leadership, some new strategic vision. That the mentality, the way that the bankers of old thought about the world have to be changed quite substantially to incorporate a lot of these new ideas. What needs to change? I mean, if you were talking to a bank and they asked you, what kind of leadership are we going to need to succeed and prosper? Or you're talking to a central bank or a minister of finance in some government, and they ask the question, what are the leadership qualities? What are the vision attributes that we're going to need in order to succeed and prosper and create value for society going forward? What would you say to them?
In fact, that is a very important question. Different countries are at different phases in their evolution of the intermediation process. Some countries are so basic that they can do with building formal institutions as the most developed countries are familiar with. And other countries will do well to be open-minded about a range of different institutions that can be intermediaries going forward. Now, some of the revolutionary ideas that I'm talking about is only meant to give us a sense of direction. When I think about intermediation, for example, when I started writing my book, I said banking as an intermediary will eventually dissolve, but it didn't. It continues to play a role. So it's not something that will necessarily go away very quickly. But the options will be broadened, and we need to be agnostic about where the options will come from. And some of the options actually come from the living, breathing society that we come from. Bangladesh, for example, just through NGOs, has developed an economy where the per capita GDP is today higher than its neighbor, India, which is a much bigger and much more vibrant economy. And that made the Indians very upset because, how did this country become, a successful low-income country? And that's because of the network effect at the grassroots level, which was held together by the NGOs in a country where the political system was totally dysfunctional. So the financial intermediary business can transform even in unstable societies.
So I apologize, but that particular example, I've looked at Bangladesh quite a bit, and that perspective is absolutely fascinating because I had always thought that it was just that they had taken over so much of the global textiles industry, and that I was concerned that its huge dependence on textiles being such a massive part of their economy made the economy fundamentally unstable. But you're suggesting something a little more nuanced, that there actually is an infrastructure in place, that perhaps textiles is just one of the industries that could be built on top of this institutional infrastructure that provides a modicum of stability for the society. Am I reading that right?
A lot of what they're doing is still textile-based. 80-90% of the economy is textile-based. But it used to be that they only produce cotton. Now they're bringing the textile into the country to be completed as finished goods to be sent out. And layers of industries have formed where you have tailors, you have cutters, you have designers in the system. And so there's a lot more depth in the textile industry. And yes, it is a one-trick pony at the moment, but it's only phase one of getting out of that dire situation in which they were in. Then they will go on to phase two, that the children of this generation will then be able to broaden out the base and build other industries and all of that. So it's an evolving story in that way. If I was talking to a central banker or the chairman of a bank in any of these emerging countries, I will say, take stock of where you are in that journey, understand the direction that the industry is heading and how the whole idea of intermediation is going to be transformed, and then figure out where you are going to be in the next step or the step after. In a number of countries, the banking industry is no longer the most productive industry and no longer the most rewarded industry in terms of capital and return on investment. And there, the banks have to start looking for alternative forms of intermediation that are cheaper, closer to the ground, and apply less capital. But we need to know where we are heading, the general sense of direction, which is that do not try and offset or get around the idea that at the end of the day, the end user is going to be more powerful than you as an institution.
That's really interesting. And I think that mini case study is a really interesting way to kind of put a bow on this conversation. I think, if I'm reading you right, what you were basically saying is that if you're a policymaker, a decision maker, there are going to be phases, phase one, phase two, phase three, and you are going to have macro policies about reindustrialization or specialization or resources or whatever happens to be. But fundamentally, there is a new underlying infrastructure that is foundational as an enabler that's going to allow you to transition through those planned phases, and that you need to think strategically about what those enabling forces are. And you need to monitor these emerging technologies and understand the impact of their intersection, because it's going to be defining. I think that's what you were saying. And I think that's a really great way to put a bow on this conversation. I'm sure we could go on for hours and hours, if not days and days, on this topic. And I do hope that perhaps we will be able to revisit this topic and perhaps do a future episode that goes into some variation or some event happens. If you'd be willing, I'd love to have you back to do an analysis or commentary on what's going on out there.
Happy to do that, Doug. In fact, I would be interested to see what your listeners are interested in so that we can drill down on some of the points that we raised. I think we travel a lot of ground, but
great point.
drill down.
I'll put a little survey on this podcast and ask if there's any topics in this area that listeners would want to investigate in some greater detail. That's a great idea. Well, thank you so much, Emmanuel, for joining us.
I enjoyed the conversation.
And thank all of you for joining us for this episode of W3B Talks. You can find out more information about Emmanuel's work at emmanueldaniel.com. You can also find out more information about this and other topics as well at blockchainresearchinstitute.org. I'm your host, Doug Heintzman. We hope that you've enjoyed this episode, that you will join us for our next episode of W3B Talks. Thanks for your time. Bye now. Thanks, Emmanuel.
Hey, thanks, Doug. That was wonderful. Thank you very much.